is there a strong sale from the end of your distributors before the new surrender value or the higher surrender value guidelines kick in? And in that sense, could September be a very strong month in terms of sales, just on the back of making the most of the last 15 days?
It could be for the sector. It won't be for us. We will not do any fire sale. The paradox is these products, why is our regulator bringing out these changes? Because the products are going to be better for the customer. What is the implication of a fire sale? That means something good is going to go away and hence buy something in a hurry. The products are going to be more customer friendly. So we will stay away from a product sale. We've had conversations with our partners that we will not do any fire sale. The products we are not going to reprice our IRRs because of these regulations. It is going to be what they are. And the products, because of the surrender charges, are going to be better.
Correct.
Right? So it's going to be businesses. If we reprice, it's only going to be what we would have normally repriced because of interest rate movement.
Now, just to extend the question of surrender value, October 1, we have about less than 1 month to go before the new guidelines kick in. Personally, if I have to speak to the company, are you in any need of any extension to that timeline? Or do you think you're completely prepared and you'll be able to roll out all your new products before that 1st October deadline kicks in?
I'll answer this in a couple of parts. One is that yes, we are ready. This is the regulator's endeavor to make products better for the customer, and we respect that. And whatever pain that the industry goes through, in the larger scheme of things, it will hopefully expand the market. It will increase the trust between customer and us. So how do we move towards it? And also this has been told to us a few months ago, so we've had some time to digest it. That technically the products that are not compliant have to be withdrawn. So our appeal and our ask has been that let us not, give us a little bit more window period, say 1 quarter, of products that are not compliant, not to withdraw them. But at the same time, fine, we will not sell those products, but let us not withdraw them. It's a technicality, because otherwise I have to perforce withdraw them.
And then
refile them. That will mean delay and a lot of work for the regulator as well, and so on.
Just to extend this question, as far as the new products are concerned, what do they entail on the pricing side? On an average, what could be the increase in price for you also to sort of make that little bit of legroom for the extra surrender value that you'd be paying? Is there any change at all that comes from the pricing? If yes, then if you could help us understand with numbers, what could be the average increase in price?
I think you mean decrease in IRRs, right?
Yes.
Yeah. So I think there will be some calibration in terms of IRRs for the sector. However, like I had mentioned, for us, there's not going to be a material change due to these regulations, and I'll explain why. First of all, we do dynamic pricing, and if you look at our IRRs over the last say 24 months, you will see that when interest rate movements happen, we reprice immediately for new business. What I've already sold, I can't reprice, but for new business. So that is number one. Number two is our persistency levels are fairly decent at about 92% in the non-par book. So that also helps us, because the surrenders themselves are fairly low. Also, most of the guys who exit become paid up. So they're still our policy holders, and so the surrender amount what hits us is contained. As a result of which, the amount of tweaking that we'll need to do on IRR repricing will not be material.
One question in terms of course, what the new surrender value regulations also bring is the change in the commission structures. We will see a lot more of deferred commissions coming in. We'll see clawback of commissions coming in, especially on the bank side. Of course, individual agency force, you can't do clawback. A combination of these two, which will dominate in terms of the larger size of the book? Would it be deferred commissions, or would it be clawback? And with the extent that you would be applying deferred commissions, how does the balance sheet work in terms of the impact on the cash flow? Simply, what could be the quantum of increase in the cash flow that you could see because you're paying those commissions in a graded fashion?
I would see this solutioning as being bespoke. And before I get into which one and so on, This is a tectonic shift because the product architecture itself is undergoing a significant change, which was never the case earlier. And even PAR, which has been around for 44 years, longer than when we were born as a sector, private sector, itself did not have this. So we are changing the game very significantly. As a result of which, there has to be skin in the game between customer, the intermediary and the manufacturer, which is us. With some companies, there will be customer will have to bear the IRR. With some companies, the distributor will have to bear more. Sometimes the company itself will have to bear. In what is the sharing of it will be bespoke depending on all the nuances of the relationships and pricing power as well, and many other such things.
Okay.
Now, where we are concerned, these are some of the tools wherein we have said that whatever is the impact, we will try to minimize it to a non-material impact, which will be a combination of clawback and deferred commission. And little bit we might absorb, like you said. Cash flows could see the cash flows could be a little bit more favorable, because if you're going to pay only, in my example, 80%, then 20% you will retain, and then you will do a true up down the line. But it's not really going to be a P&L impact, and I'll explain. So if you think that you've paid cash of 80, but you're likely to pay 90, then that 10, any CFO will say, I have to provision for it.
So far in the year, have you taken any price increase as far as the protection book is concerned? What has been the quantum of that price increase? And was it more of an installment of a larger price increase that you want to take? And there could be more lined up for the balance part of the year. And if yes, then what could be the balance quantum that would come through?
So it's not that carte blanche we have taken a pricing increase the way you saw during COVID. It's very nuanced in a particular cohort of policies that are exhibiting poorer claims.
But 10 to 15% has happened in the protection book so far. Is that the...
In certain cohorts, yes.
Okay.
At the same time, in some of the other cohorts, during that time, nothing has happened.
Correct.
Or even a reduction might have happened.
Are you experiencing exactly to the point that you made, which pushes you to take that price increase more in the balance part of the year?
We will. See, there are many nuances. For example, somebody who does not have access to good health care or nutrition. And as we move wider, there will be some of these nuances.
Okay. One final question as we conclude the interaction. IFRS, that's the next big thing as far as accounting is concerned. A lot of things change. Your expenses do get spread out across the term of the policy, which impacts AP, VNB margins. How prepared are you with respect to IFRS? What is the internal understanding in your conversations with the regulator in terms of applicability of IFRS onto life insurance companies? And if it happens, could you give some estimation in terms of what could be, taking the current financials that we have in our hands and putting them as the prototype, what could be the increase in margins? What could be the impact on AP?
On the last question, no increase in margins because this is economics don't change.
But
it's
because
only the
your
accounting.
expenses reduce and the
Economics and the margin will still have the expenses.
Okay.
Regardless of how you show your expenses will be incurred. Like we are incurred. There are no expenses today other than say depreciation that is not expressly in cash. And even depreciation in capex I've incurred it in cash. So there's no...
But denominator falls because AP shrinks.
AP shrinks, unit linked will shrink the way we know unit linked. So the optics of the margin will depend, what it is. I don't want to jump the gun because some of the detailed insurance contract accounting is still not ironed out, and so and there are many avatars of it. Will it be Indian suitability for some of the products, given how large unit linked is for some companies and so on. So going back to your first question, we will be prepared and we will meet whatever timelines that the regulator wants us.
What should one expect in terms of timeline?
I think we should expect in the forthcoming fiscal.
Thank you so much for speaking to us for this extensive discussion. All the very best for everything that you've planned out for the company. As always, it's lovely speaking to you. Thank you once again.
Thank you so much. Thanks.